Hi everyone. If you're just getting started with technical analysis and need help learning how to read a price chart and need to learn about Japanese candlesticks, then stay tuned. Alright, hey everyone, and welcome to the very first segment of my technical analysis series. I plan on rolling out a few little videos on getting started with technical analysis, and I appreciate you for checking this one out. I know there are a lot on YouTube that offer, I'm sure, great detail. I personally haven't watched them online or anything like that, but I did see that there are quite a bit of Japanese candlestick videos and technical analysis videos as well. That being said, I use Japanese candlesticks, but I don't use them solely just for that. Like, I know Forex traders basically just use candlesticks to determine what they're doing. I personally don't do that. In this video, I cover the few Japanese candlesticks patterns that I use. I don't use them all. Last I heard, there was about 377 different patterns, and to me, that is just too much to deal with. Trading doesn't have to be that complicated. It'd actually be pretty simple if you let it be. So, that being said, if you want to be available for my next video that I put out after I cover this, I'm thinking about covering moving averages and a few other indicators and just snowballing everything out from there. So go ahead and if you haven't already, hit the subscribe button and let's get rolling. Alright, so how to read a price chart. If you don't know, it's honestly very simple. You have three main different sections, basically. On the right, it's like a graph, just like any other graph. So first of all these things right here, those are all candlesticks. Those all tell price, and I'll get more into those later. On most platforms on the bottom, you have volume. That's where you can see how much volume is traded, and you can see the validity of a movement and things like that, but I could get into more of that later. On the very bottom, it doesn't matter what time frame you're on, it tells you the time frame. So in this case, this is the S&P 500 ETF, the SPY. This is its daily chart. So each of these little candles are actually they represent the price movement within one day. So on a daily chart, every little one of those is 1 day. And then also on the right side over here is where you see the price. So basically, for example, this one right here where it has a long tail and it comes back up, it basically closed at 280. So that's how you would view that. And then like right here, 300, you can see price was held for the majority there. So that's how you tell where price is and where it may potentially go. All right, so like I said, reading a price chart, very easy. And now we'll go to Japanese candlesticks. All right, so the history of Japanese candlesticks, everything I've ever read was that it was created by a Japanese rice trader in the 18th century, and I'm not even going to attempt to pronounce his name. I will ruin it. But from what I understand is whenever him and his partner started creating it, he was able to read the imbalances in supply and demand from trading rice from that long ago. And then in the 1990s, they were brought over here to the U.S. and the Western world by Steve Nissen. He's known as the godfather of Japanese candlesticks. He has tons of books on it. He has an online service. He has scanners that scan for specific candlesticks. If you want to focus strictly on candlesticks as your trading method, I'd say go check out his website. You can Google him. I'm sure you'll go to his website and you could check out all his stuff. But he basically brought it to the US, and it's been here since. Alright, so this is a Japanese candlestick. I'm sure you guys and gals have seen them on charts, if you've been entertaining the idea of trading, probably looked into it a little bit here and there, and you see these and you may wonder, well, how do I even read this? So how it works is, so we'll say the red one is for a down candle. So just like it says right there, that means price opened right here. So let's just say that's $50. And then and we'll say down here is, whoa. We will say that down here is 40. And we'll say right here is 43. Why not? Excuse the horrible writing. Kind of hard to do on a computer screen. But so what does all this mean? So means price, what it could have done right here is say we opened up at 50. It went up and touched, we'll say 55, sold down to 40, and then closed right here at 43. So that's what it means. So this was the high of the day, this was the low of the day, and this is where it closed. Just like what it says on these little things right there. And it's the same thing right here. It could have opened right here, sold down for a little bit at the open, and then was bought up through the day, hit a little bit of resistance, and then came back down a little bit into the close. That is all that's how you read a candlestick. It may seem confusing at first, but honestly it gets a little bit easier as time goes on. Now, in each candlestick is in a time frame. So in that last chart I showed you, where each of those candlesticks was a day, you could do the same thing on a 1 hour or 5 minute, 1 minute. I've seen one down to 1 second. I've seen it down to or up. You could do it on a monthly time frame. So that is how it represents price within the time frame. And so just to give an example here, on the top, I have the daily, the weekly, and the monthly candles. So what does that exactly mean? So like I said, one little candle right here equals 1 day. Now, one of these candles equals 5 of these candles. So let's see if I can do this right. So it says Wednesday, those 3 candles are actually in that 1 candle. And down here in the monthly, each of these little candles equal an entire month. That's why you can see how many years it's on, because every 12 candles equals a year. So you can see relatively, since the crash in 2008, we've been going up. So that is, I wanted to show this as far as time frame and how it works. So like this big drop right here in the weekly chart is actually this drop right there. So you have several candles right there that show it, but it's actually 2 candles on the monthly chart. That's just something I wanted to show so you understand as far as time frame works and how it all works within one. Okay, so these are my 5 main bullish reversal candles patterns that I use with my technical analysis. One thing I could think of that I didn't comprehend, maybe I wasn't listening, maybe I just didn't catch it, maybe it was never told to me, I don't know, for whatever reason, something I had to learn along the way. Like I would see a bullish engulfing candle and price action is moving sideways, or that's not off of resistance. It doesn't work as well when that happens versus if it's off of one of those levels. Now, I'll show you what I mean. So say price is going down, right? Price going down, and we'll say right here is $50. So it comes down, and then boom, right there is where you would want to see a bullish engulfing pattern and a spike in volume on the bottom. Remember the bottom of the chart? There's volume down there. You spike in volume, and then you would see it continue higher. That's something. So you can't just see one of these patterns in a sideways moving, or if it's not off of support or resistance or moving average, something of that nature, it doesn't work all on its own. It needs to be based off of one of those levels. All right, so we'll go ahead and get started. So first is the bullish engulfing candle. And I have a real example off to the right side right there. So basically what happens is, so on day one, say, like it says right here, you have a downtrend, and then at the bottom, right here at support, you get this red candle. The next day, it gaps down. So it opened right there, right? Remember in the beginning? Now the buyers are buying it all the way up. And the reason it's called engulfing, because the body engulfed this entire candle. That is what you'd want to see on that one. And then, like I said, an increase in volume. So like it says right there, you go on a downtrend. You have a bearish candle, a gap down, it has to gap down. And then a bullish candle closes above, engulfing that previous candle. So right here on the example, like it does right there, gaps down, fully engulfs it. The next day it gapped down again, but then you see it continued a trend higher for a few days or a week later. That is a bullish engulfing candle. You want to see that at resistance levels. And that's how you get confirmation that at least a short-term bottom is found and that the buyers are in control. Candles help you find where imbalance of supply and demand occur. So right there at that level, that's where demand increased. So the buyers came in and then took it up. And the next one, the Dragonfly doji. So the way this one works is, so basically where it opened and closed at the exact same level. So it opened at one level. So sellers took it all the way down. Buyers took it all the way back up right to where it was open. It is still somewhat indecision. You still want confirmation. Like me personally, if I see it, I'm not going to buy it and then hope for it to go up the next day. Me personally, I would want for confirmation for the next day to be a green candle, and then I would buy and then ride it up, because it's still somewhat indecision. To me, it just seems like I want confirmation. And then right here on this example, so you actually see right there that wick, that's support. The sellers took it down, it hit that level. Buyers came in right here, so they came in at the same price level and bought it all the way up, and then you see it slowly turn back up. So downtrend, had a long wick. I didn't say that in the beginning, but these long, if you ever hear anyone talking about a wick, this is what a wick is, where the price went down and back up. So this part's a wick, that's a wick, that's a wick, wick. So that's where it shows an imbalance happened. And then that's how you ride up. All right, the hammer candle is one I do like using quite a bit. I do scan for these ones quite often. So you have a downtrend, and the lower shadow at least twice as big as a roll body. I do look for long bodies, but if it's not exactly double, I don't really bother for it. But basically, so like same thing, it came down to support. Buyers came in, you could wait for confirmation the next day, buy it, and then statistically it should go back up. And those are really good off of moving averages. I believe I saw a real example of that for the moving average idea is right here. So you can see price was all the way down here, gapped all the way up. Yeah, that made you draw that better. It could be better done. So price closed right here, gapped up to right there. And then the sellers drove it all the way down. That orange line is the 20 SMA. So right there, Man, I am sorry, guys. Maybe it'd be better with the mouse. Right there is where the buyers came in and bought it back up. Same thing right here. So see, we got support right there. Our resistance became support, broke through, support, boom, up. Same level, came right there, gapped up. Came back down, buyers came right in at that level again and bought it up. So that is how that works. Hopefully that makes sense. It shows you where the sellers were in control, and then the buyers came back in and bought it back up. So Harami pattern. So here is the bullish and bearish version of it. Harami actually means pregnant in Japanese. So that's where it comes from, because it is basically saying this is the body and this is the pregnant belly. That is where the name comes from. Little fun fact for you. So Harami, so it could close for a bearish position. So it could close higher one day, gap down the next day, and then usually it will show a continuation to the downside. It almost shows a partial indecision is how I always viewed it, because the reason I consider it a partial indecision, because you can see, like in this example, there was such a lot of selling of these big red candles, right? And then all of a sudden a pause, a little green candle. So it's all right. So maybe the buyers are back in. The sellers stopped. They didn't take it back down, and then it curved back up. Same thing with up here. A lot of buying, and then just a little Harami, and then back down for a little bit. And so this is how you could pinpoint short-term tops and bottoms. And if you need to, you could always pause this video and look at the notes I have on the side to help explain it better, and things of that nature. Next, the piercing pattern. So, for a bullish, so say it's selling off, gap down, and then buys up, and it closes 50% above of the 50% of the body of your bearish candle. So like it shows right here in the example, the gap down, and then it came up above 50% of this body. And then once again, you would want to see, if it was down here, you want to see a spike. And so say this is the first day, this candles, but on this day you have a big old spike. That's a good sign. The volume always confirms direction at these little pivots. Okay, here are the bearish reversal candles. They're typically the same thing, just the back side or the opposite side of the bullish ones. They're all pretty much the same. You just reverse it, and I'll show you what I mean. So the bearish engulfing candle, pretty much the same thing as the bullish engulfing candle, except it's engulfing to the downside. So right here on this right here shows actually a pretty good example of like support resistance. So say this part, or let me say this part hasn't happened yet. So you're watching it and you have this trend line drawn, or that resistance level drawn. So you have it drawn, you're watching it. The next day you see it gapped up and that resistance level held, it pushed it down. And then it closed right there. You're like, oh man, that's a bearish engulfing candle. All right. And then you have your spike in volume as well compared to the prior day. All right, I want to get short, at least for a little bit. And then you can get short. So that's what I mean by finding it or doing the candle pattern off of support or resistance. And this was a good example of that. All right, gravestone doji, complete opposite of the dragonfly doji. You see it opened, buyers took it up, sellers came right back down, and it closed right at its or right at the open. So like I said, on these ones, you would eye personally. This is just me. You don't have to eye wait for confirmation. So me the next day, as I would wait for this candle, and then you could set your stop above and then see if it continues lower. All right, dark cloud cover. So the day one, it's obviously a bullish candle. And the next day, gaps up, sells off, closes 50% below of the bullish candle above. And so, like, say right here was that resistance level. And once again, same thing. Boom, sells off, spike in volume. It's been a good one because you get your gap down and it goes down pretty good. So just remember, off the support resistance level, volume increase. And this one particularly, you want the gap up, sell off below 50% of the body, and you get short. Shooting star is just a complete opposite of the hammer candle. You see the open, spikes up, and then sellers come back in, pushing it down, and it closes at the low. And then that's usually a good indication of resistance holding. So same thing. So you were looking right here, you saw that resistance. He keeps on trying, resistance held. Tries again, resistance held. And then right here, you're like, oh man, we got above it. Yeah. But then intraday, towards the close, it sells back off and closes at the low. I only know from experience because I would think, all right, we broke resistance. I want to buy. And then you come back later and it's at the low, and then you take a stop or you take a loss because you got in too early. But those are just a few things to look for. But that is it, everyone. Thank you very much for watching. If you have any questions, write it down in the comment section below. I will for sure get back to you, answer any questions. If you haven't already, subscribe. And I look forward to hearing from you on the next one. Take care.